All right, let's get a checkup on the markets and what to do with certain areas of the market, like the NASDAQ 100 at all-time highs. Bob Dahl, CEO and CIO of Crossmark, joins us now. Bob, I thought we're supposed to be off our tech stocks, right? 2024 is going to be about the S&P 490.
Yeah, there's a lot of thought that that's the case. Look, the beginning of the year, those stocks, that is the Magnificent Seven, really struggled. They're coming on again. I think it's going to be a yo-yo like that for a while. I suspect at the end of the day, there'll be some catch up from those cheaper 490.
And so what is underpinning that view?
So I think that the economy is okay. We're still in the early days of earnings. They're acceptable. I'm not going to sing a happy song because some of the 2024 calendar year numbers are still coming down as a result of the conference calls, and I think there'll be more of that also, Amber. I think earnings estimates are a little too aggressive for the economy that the U.S. faces this calendar year.
So where are you looking then for opportunities? Are you completely staying away from tech exposure? Or are you just staying away from maybe the more headline grabbing areas of tech?
Yeah, the latter doesn't mean we don't own them. We're just underweight some of those mega cap stocks that have done so well that are more on the expensive side. So we're trying to look for names that haven't been exploited that still benefit from the same trends. One of the names, for example, is Qualcomm, QCOM. That's a integrated circuit manufacturer. The problem is they serve a lot of mature industries. They're trying to diversify, but you only pay 15 times earnings, pretty unheard of for the semiconductor space, which has done so well.
And we're looking at the chart, and you mentioned that earnings multiple, which certainly is very low, but the stock has kind of run up. It sounds like you're saying there's even more upside to go.
We think so. Look, management recognizes they need to serve faster growing areas of their business, and they're working hard to do that and having some success, and that's part of the rally in the stock. But what it represents, and I think more broadly, you want to own companies that have earnings persistence, some earnings consistency, good cash flow, as the stock does.
Earlier, before the break, I was talking about one of the components of the Magnificent Seven is Tesla, and it's looking less and less magnificent. Is that one that's starting to get on your radar because of the underperformance, or are you still not so keen?
I'm not so keen, Amber. I for one think the stock expensive. I don't understand how they think they're going to make the numbers that they're talking about all the time. So it is the only of the Magnificent Seven that I own none of, and would still avoid the stock. Watching as it underperforms, but not tempted yet.
Earlier in the show, we talked about these insurance companies, these health insurance companies that seem to be spooked by fears about rising medical costs that United Health and Humana reference, and it's taken down kind of the whole sector. Are you sniffing around there at all?
Yeah, I own those stocks, and so have taken a bit of a hit this week. The one I like most in this category is Cigna, but most of them on this pullback are viable in my judgment. Look, these are companies that have less of a cycle than they used to. They're pretty cheap stocks. Cigna, for example, selling at 12 times earnings, and that really has a shot at high single digit, on occasion low double digit sales growth, earnings growth, cash flow growth, and so you're not paying a whole lot for it. These stocks have done very well in recent years, lagged last year, and so that's part of the appetite to add to them.
Where are you going to kind of hedge your bets on your view? Because it sounds like you're still constructive, but you want to be selective. If things start to fall out, is there a place that you would just have some exposure to hide out in?
Yeah, so I come back to those characteristics that I referenced very quickly earlier, and that is own companies with earnings quality, earnings persistence, good cash flow. Don't own companies because you think the valuation is going to go up. Valuations are pretty full, so the companies have to deliver the goods. And the two I've mentioned already, Cigna and Qualcomm, we think have those characteristics. I would add to it Home Depot, not a particularly cheap stock, 24 times earnings, but it's the leader, as you know, in retail home improvement and retail supply. And they're doing a great job in a increasingly difficult environment.
Yes, very difficult, I guess, because the housing market in the U.S. is so stagnant, so people are not rushing to refresh their homes as much. But then you get data points like the retail sales numbers, and they're just still so resilient and robust.
They are. The consumer still has money. Some of it, believe it or not, still from the cash they received or didn't spend during COVID, although that's running down. But, unemployment rate's low, so a lot of people are working. Wages are up, so there's still buying power, and that's why you see some of these consumer names do just fine in, to repeat, an increasing uncertain environment.
Bob, thanks so much.